Right, well, let's just recap what those indicators mean. Remember, we don't actually need to know what they mean in order to be able to interpret them and trade off them, but some people like to know, just to make sure that we've done the science behind it. The rate of change indicator compares the price today with the price end periods ago. It tends to be very active, very volatile. It gives too many false signals. I wouldn't rely upon it ever on its own. The RSI is a little bit slower, gives fewer false signals, but still wouldn't rely upon it on its own. It goes from a 0 to 100 level. It always trends between those two. It compares the current level to its own strength relative to its highs and lows a number of periods ago. And again, the trick to remember with this one is if it's above the 70 level or below the 30 level on the 0 to 100 scale. Again, you use the similar principles which I mentioned before. Positive divergences, negative divergences, add it to the stochastic and the MACD, and that's far better looking at all indicators together. What about the MACD? I've described that before, the difference between the 26 and 12-day exponential moving averages. What about the stochastics? Well, again, the idea is on an uptrend, prices tend to close near their highs. When they stop doing that, the stochastic shows you mathematically some kind of indication here. My favorite indicators, the MACD and the stochastic. The MACD tends to be a bit slow in giving me indicators. Stochastic tends to be a bit fast. When I look at them together and I look at the stochastic giving a signal and then the MACD just turning, not waiting for it to break its own signal line, just turning, that's probably the ideal turning point, especially when I'm looking at bearish or bullish divergences. They give me the best entry points. Now, ShareScope, why have I mentioned that? Well, people ask me, where do I get all of this information? One place is sharescope.com, the other one bigcharts.com if you're into US stocks, advfn.com and its charting, and have a look at alpeshpatel.com. Other sites, have a look at Equus if you want the software, which is by a company you might have heard of called Reuters, who produce that software. Have a look at the Market Technician Society if you want to learn more about these types of indicators. Okay, moving on. What about other forms of software? Now, let's have a look. What can I tell you? What I would say is the following. Most people ask me, what types of software, how much do they cost, where can I get them from? Well, there you go. These are the main ones. I tend to find Metastock the best value for money. Omnitrade is good in that it gives you a lot of different signals together. These costs are just indicative at the time of when I wrote this. Supercharts, Telecharts, TradeStation, etc., 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 and so forth. Do try the demos on all of them. That's probably the best way to go. That's me up there, getting podgier by the minute, just trying all the websites. But when you do go through them, you'll probably get a good idea of which ones work for you and which you like. Well, let's continue. Let's roll on with the various indicators and let's continue looking at the stochastic. Now, I've mentioned it to some extent before, and I've said it can be a bit quick, a bit premature, give some false signals, and give some short signals. You can see here, just starts to move higher, goes all the way to the other extreme, but the price has hardly moved. Do you see why I now need to look at it with the MACD and not by itself? Divergences? Well, let's have a look at how it works so much better with those. Bullish divergence, higher high, price only slightly to higher, and that's when it tends to move ahead. That's why divergences are a bit better. But look at this. Bullish divergence, nothing happens. Absolutely nothing. And that's to show you it's not 100%. Always 7 times out of 10. Here, it's a lot better. Another massive, fantastic rally. So that's the point there. Okay, let's try an exercise. What's the reasoning behind momentum indicators? What is positive divergence? What is negative divergence? Have a think. You can put it on pause if you like. And if you want the answer, you've still got a chance to put it on pause. But if you don't, then here's the answer. The rationale behind all momentum indicators is that a security price moving in a particular direction tends to slow down before reversing direction. So if we can pinpoint the slowing down of the price, we can try to predict reversals. The purpose of all momentum indicators is to indicate how overbought or oversold a security is. One way to trade oversold signals is to buy the security when the momentum indicator moves up from being oversold. This is too simple since momentum indicators go oversold often, but can be useful evidence. NB. Momentum indicators can go up, but the price could go down. Okay. Use momentum in tandem with other evidence. For example, if momentum is oversold and just starts moving up, the price in a rectangle formation and just starts to break out. You'll be more confident in the move because you will have two independent strategies. A positive divergence occurs when the momentum indicator makes a higher low, but price does not, and a popular strategy is to buy as the momentum and the price rise after the price makes its higher low. This is not foolproof, but is more reliable than simple oversold signals. And finally, negative divergence occurs when the momentum indicator makes lower highs while the price does not, or even the price makes higher highs. As the momentum indicator then starts to fall from its high, overbought territory, the price should also start to fall. Again, this is a stronger signal. And just a reminder, negative divergence, the price made a slightly higher high, the momentum indicator didn't, bang, we want to get the heck out of there. But look at what else we're doing, we're combining indicators. That's the FTSE, it's the same thing, negative divergence. We look at the stochastic, well, it's only showing us that it's oversold and moving lower. Momentum not really telling us much, so we might ignore it, but we are getting bearish at this point, and there's nothing in these two indicators to deny we shouldn't be. Yeah? Let's look at this. Good old Halliburton. Professional approach. Positive divergence starts to move higher, it breaks out. We here, in our professional approach, we've looked at a breakout of resistance before we've got in. That's what was professional about that. What about here? Well, it's using all the indicators. And I'm talking about this point here. The price starts to, the MACD starts to move higher. Stochastic, slight extreme, positive divergences. Look at those positive divergences. Stochastic oscillator, the momentum, yep, slight positive divergence. What's the entry point? Probably as the MACD starts flattening. Not as the stochastic moves, because the stochastic's a bit early. As the MACD starts flattening, before it gets to the signal line, I usually enter at almost precisely that point.